Okay, my camera stopped working. Anyway, so in our previous question, we had a journal entry of interest expense, debited, cash credited, which is going to be the same every time. In this case, we're crediting the discount when we amortize it. In this case, we're going to be debiting the premium. So that's really the only difference. Now, looking at our amortization table, we can just grab the numbers straight off of the table. We're making cash payments of $400. We're amortizing our premium. With these numbers, we would write 86, but with your numbers, I believe we're amortizing the premium by 100. And then our interest expense is going to be 300 on your guys' numbers. Not too bad. Now, the tricky parts, or something else that they might ask you about is, let's say we redeem the bond for 10,050 at the end of year 4. Let's do that. So we're redeeming the bond for 10,050 at the end of year 4. The journal entry for that, well, we're buying back the bond for 10,050, so we're paying cash of 10,050. A credit to cash, there's our first. We're also getting rid of the bond payable for 10,000. So a debit to bond payable for 10,000. And then we're going to have to look at our amortization table. We're also going to get rid of our premium, the remainder of our premium, by debiting our premium. And our premium at the end of year 4, in this case it's 97, but I think in your guys' case it would be 100. So we're getting rid of the premium by 100, and I saw that because our carrying value of the bond is, the face value of the bond is 10,000. The carrying value at year 4 is 10,097. Subtract the 2, the premium is 97, or in your guys' case, it's going to be 100. So debit bonds payable for 10,000, debit premium for 100, credit cash for 10,050. The last part, it looks like we need a $50 credit, and that's going to be a gain on the redemption. Gain on redemption of the bonds. Now, if we needed a debit, it would have been a loss on the redemption. Okay, moving on to number 6. The amount paid at maturity to redeem a bond is, well, we just did a question about redemption, so it should be fairly easy. The sum of the interest payments. That is not correct. Oh, I'm sorry. This is, we're redeeming the bond at the maturity. So the last question is not really related to this question. So at maturity, at the very end of the bond's life, so like number 4, I believe, we made a journal entry for debit for bonds payable for 100,000, credit to cash for 100,000. This is on the redemption at maturity. So the amount paid is the gain or loss on the redemption. No, there's no gain or loss on the redemption at the maturity. There might be a gain before the maturity, or might be a loss before the maturity. So B is wrong. C, at the bond's par value, that is correct. We always redeem the bond at maturity for the face value, or the par value. And then letter D, the contract rate times the bond's face value. Incorrect. Number 7, we've got a company that redeems a $1,000 bond at 101 when its carrying value is $870. we would journalize. So we kind of already did a question like this. We're going to debit our bond payable for the face value. The face value is 1,000. So there we go. Debit bonds payable by 1,000. We're going to credit cash for however much cash we're going to pay. In this case, we're paying 101% of the bond's face value. So that's going to be 1,010. We're going to get rid of this discount. Right now its carrying value is 870. Therefore, its discount 1,000 minus 80 or 870 is 130, I believe. Get rid of the discount for 130. And then whatever is remaining looks like we need 140 as a debit. And there's our loss on the redemption. Okay, that was number 7. Moving on to number 8. Alright, just asking about moving on to stockholders' equity, it looks like. So, the owners of a corporation are the bondholders. No, they are not the owners of the corporation. They just lent the corporation money and are charging interest. The CEOs, no, they just work at the corporation. However, they could be owners of the corporation if they buy stock in the corporation. But at plain surface, the CEOs are not the owners. Letter C, the board of directors, no, they are not the owners. And D, the shareholders. That is correct. Whoever owns the shares are the owners of the company. So we've got a corporation that issues 1 million shares of common stock for $1 par, or for $1 per share. Par value is 75 cents. If these are the company's only issued shares, common stock at par on the balance sheet will show up as a balance of. So let's just do the whole journal entry. So if we issue 1 million shares at $1 per share, that means the company is going to get $1 million in cash. So we're getting $1 million, debit cash for $1 million. We're then going to credit common stock, but we're going to record it at par, 75-cent par. We've got a 75% par, or 75-cent par at 1 million shares. That equals, so 0.75 times 1 million is $750,000. And then the rest of it, we just throw into this thing called additional paid in capital. For the to be more specific, for the common stock. For the rest of it, so the 250,000. The 75-cent par, or it could be $1 par, or it could be $5 par. It kind of depends. The par value does not have any real significance. It's just, from what I know, it's just a legal thing that corporations have to do. This additional paid in capital, or these, the common stock at par and the additional paid in capital, those two summed together equals the total value of the common stock. So on the balance sheet, you'll literally see something like this. Common stock listed at 75-cent par. Here's the value, and then the additional paid in capital right below it at 250. Sum those together is the common stock total. Well, the question's asking for what's the value of the common stock at par on the balance sheet. Well, we recorded common stock at par for $750, so there's our answer, letter B. Number 10, we've got a company has 500,000 shares issued and 100,000 treasury shares. A 50-cent cash dividend per share is declared and paid. The total amount of the cash dividend is. So in this case, we're going to have to figure out how many shares are outstanding. The number of shares outstanding, get the dividend, and we can figure out our calculation from there. Maybe something good to point out is the difference between issued shares, outstanding shares, issued, outstanding. What's the third one? Let's see. Issued, outstanding. I'm blanking on it. Issued, outstanding, issued, authorized. So we've got authorized, issued right below it, and then outstanding. Authorized is just how much shares I believe it's the board of directors, how much the board of directors authorizes the corporation to issue. So maybe, let's say, what do we got here? So, let's say the board of directors authorized 1 million shares to be issued. You cannot, or the company cannot issue more than what is authorized. In this case, we've issued 500,000 shares. So we've issued about half of what we're authorized to do, which is fine. We can go more if we want to in the future, or we don't have to. So we've got 500,000 issued. The number outstanding at one point was probably 500,000, but now we've got 100,000 shares of treasury stock. Treasury stock is stock that we buy back. So treasury stock is no longer outstanding. So we've issued 500,000 shares, but we've bought back 100,000 shares in treasury stock. So the number outstanding is 400. And so hopefully you can see by now, outstanding is just taking the amount issued minus our treasury stock. 500 issued, 100 in treasury, 400 outstanding. Okay, so we've got 400,000 shares outstanding. We've declared a 50-cent dividend. So if we've got 400,000 shares outstanding, and each share is getting a 50-cent dividend, that means that we're going to pay a dividend of $200,000. Letter A. Okay, number 11. Assume the company has 50,000 shares of common stock issued and outstanding. So if we've got 50,000 shares issued, 50,000 issued, and 50,000 outstanding, that means we have nothing in our treasury. The par value is $6. What would happen in a 3-to-1 stock split? A stock split it turns one stock into 3 stocks. So if we have 50,000 shares of stock, a 3-for-1 split, just multiply this by 3. That means 50,000 shares turns into 150,000 shares. Not a dollar amount of shares. 50,000 shares turns into 150,000 shares. So if we read through this, the number of shares would stay the same with the change in the market value of the stock. That is incorrect. There would be no change in the market value of the stock as a whole, at least. The number of shares would not stay the same. As we said, they would triple. The par value and the number of shares would increase. That is incorrect. The number of shares would increase, but the par value would decrease by 3. So the par value is 6. When we have a 3-for-1 stock split, the par value would be divided by 3, so it would turn from 6 to 2. So the par value would decrease. Letter C, the par would be reduced by 1/3. That's correct. And the shares would be reduced by 1/3. That is incorrect. It would be multiplied by 1/3. Letter D, the number of shares issued and outstanding would triple, correct, and the power would be 2, correct. Okay, that was number 11. Number 12. Which of the following is true about stock dividends? Okay, we'll just read through all this. So, letter A, stock dividends involve a payment of cash. That is wrong. Stock dividends involve no cash, so we can automatically know that's wrong. Letter B, stock dividends cause the number of shares issued to decrease. That's incorrect. Stock dividends actually cause the number of shares issued to increase, so just the opposite. The effect of stock dividends on total stockholders' equity is 0% or $0 change, no change in total equity. That's 100% right. And maybe we'll do an example of this. Stock dividends decrease retained earnings, but they increase